Whoa, yesterday was a bloody red day in the stock market and it seems like everyone is in panic mode. The Dow was down 2.78%, the S&P 500 was down 3.51%, and the biggest loser on the day was the Nasdaq being down 4.96%. If you're new to my channel, I'm the guy known for no hype and keeping things real, and in today's video I'm going to share with you my take on the market and why there's no need to hit the panic button yet. I'm not a financial advisor and this video is for entertainment purposes only, so grab a cup of coffee and hang on because this is not your normal stock channel. It's the media's job to hype things up, and let's take a look at a few of the headlines. The first one says, Stock Market Bloodbath, Dow and Nasdaq plummet in worst day since June. The next headline, Dow tanks 808 points as tech stock exodus drives worst day since June. I think both of these articles must have the same headline writer. And the third headline is the first one that makes any sense to me. Stock Market Rout, why it's too early to call tech plunge the start of a correction. Let's start with an image that I think will help everyone understand the stock markets better. Right now we're looking at the Nasdaq, and in an uptrend, stocks are like homing pigeons, and they always return home. And home is the 20-day simple moving average. If we look at this image, this blue line right here is the 20-day simple moving average, the red line is the 50-day simple moving average, and the white line is the 200-day simple moving average. We can see that the stock market is clearly in an uptrend, and if we follow the stock market, we can tell that it goes up, it comes back to the blue line, up, back down, and you can see that trend repeats itself over and over again. Everyone knows that we're in an uptrend and the market has been on a tremendous bull run, but when it goes too fast, too much, it's very common for a pullback to happen. And here we can see that the market went up too fast, too much, and we've had a pullback and it's came down almost to perfectly touching that 20-day simple moving average. And this is why it's no time to panic yet. This actually is just simply a healthy pullback. And in my mind, that's why there's no need to panic right now. However, if the stock market continues to fall through the 20-day simple moving average and the 50-day simple moving average, well then that's a really big concern. Now let's go over what a crash looks like on each of the different markets. We're going to start with the Dow Jones Industrial Average. Here we can see the 20-day simple moving average. We can see the stock market is going up, comes down through it, bounces back up, drops down through both of them, and this is a bit of a concern, goes back up, and then the crash happened. And notice how it blew through both the 20 and the 50-day simple moving average, and then it kept on falling, and then we can see the recovery that ensued. Now we're looking at the Nasdaq, and we can see the same pattern. We've got the 20-day simple moving average. It's constantly touching it, bouncing back off it, and here we can see that it drops through it. Area for big concern, the crash happens and the recovery. And now let's look at the crash on the S&P 500, which is my favorite to watch. 20-day simple moving average, same pattern, touches, bounces off, an area for concern, came back, and then it dropped through, the crash happened, and the recovery. And now that you know what a stock market crash looks like, we've zoomed into the 6-month chart so we can get a little bit of a closer look. And again, we're on the S&P 500 index. This is the crash, this is the recovery, and we can see that it's gone up, came back down. One time it bounced off the 50-day simple moving average and the trend continued, and now we can see how it has gone up quite a bit, and then it pulled back in one day right down to the 20-day simple moving average. And this is why I'm not panicking yet or concerned. What's going to happen in the future, we do not know, but now is not the time to panic. In fact, this is just simply a healthy return back down to the 20-day simple moving average, albeit in one big step, but again, it's just simply coming back to that 20-day simple moving average. And now let's put that 20-day simple moving average to the test and look at some of the top stocks to see where they're coming in at. Right now we're looking at Apple, and this is over 6 months, and we can see everything looks the same here. It touches the 20-day simple moving average and it moves up, and over the last 2 days it's came down and touched the 20-day simple moving average. No need for panic on this one. We're now looking at the ARK ETF, and this is ticker ARKK. This is one of my favorites. We can see the same pattern is holding true here. In the last 2 days, it's came down and touched. No need to panic again. And now we're looking at Canadian Solar, ticker CSIQ, and we can see they've had a little bit of a bumpier ride. However, they have shot up a lot, and they are still a long ways from that 20-day simple moving average. So even if they fell further, I would not be in a panic mode yet for this company because they've gone up too much too fast. And now we're looking at Facebook, a beautiful uptrend, and we can see they still have a ways to go before they reach the 20-day simple moving average. So even if they went sideways or down, I would not be panicking on Facebook either. Now we're looking at Microsoft, ticker MSFT, and we can see they're at a nice uptrend. They had a huge drop yesterday, and they actually dropped below that 20-day simple moving average. Okay, there's our first warning sign. What do they do now? That's what we're going to watch for. If they continue to drop, especially if they go through that 50-day simple moving average, that's a major red flag. If they go sideways or they go back up, then that's still the trend continuing, not a reason for concern. So what we have to do right now is watch and see what happens over the next few trading sessions. Here's another stock I've done really well this year, NVIDIA, ticker NVDA, and this is an absolutely beautiful uptrend chart. And look at the channel. We've got a beautiful channel between the 20 and the 50-day simple moving average, and this is what I call railroad tracks because they kind of look like railroad track. And then if we look at the 50 and the 200-day simple moving average, a beautiful chart, and then we can see that the stock has shot up and it's coming back down, and it's still not even to the 20-day simple moving average. And if you look at this, for months, it's been traveling right along that 20-day simple moving average. Now we're taking a look at Shopify, ticker SHOP. We can see another uptrend. They've had a little bit more volatility, and over the last 2 days, they have shot down and they dropped through both the 20-day simple moving average, and they briefly went through the 50-day simple moving average, and then they closed just above that 50-day simple moving average. So this is definitely a red flag for this stock, and I would be more concerned about this one than the previous ones we've looked at. Where they go from here, we'll just have to see. Now we're looking at Square, ticker SQ, and this is a perfect railroad track and an uptrend. We can see exactly what they've done. They touch it, they continue on. I hope this is getting repetitive for you guys because this 20-day simple moving average is such a powerful, simple technical analysis tool that you can use. We can see they've dropped down to that 20-day simple moving average and they closed above it. I know some of you are thinking, well, does this work on a stock like Tesla? Well, let's take a look and see. Even a crazy stock like Tesla that has had crazy run-ups, they're still following this simple 20-day simple moving average rule. We can see they shot up like crazy, they're coming down, and they haven't even touched that 20-day simple moving average yet. Don't panic, stay calm. And last but not least, I thought I'd finish with a doozy for you guys. Check out Zoom Video Communications, ticker ZM. Here they've been beautifully following that 20-day simple moving average. Everything looked healthy. They went sideways into consolidation, bouncing around for it, dropped briefly below that 50-day simple moving average. They had earnings come out and they shot up like crazy. The last 2 days they have been down, but look at how far away they are from that 20-day simple moving average. They still have a long ways to go, and eventually, like a homing pigeon, they're going to come back to this line. This is why investing in Zoom right now is very dangerous. You could have great gains or you could have great losses, but this tells me very volatile, very dangerous. Let's do a quick recap. If the stock market breaks through the 20-day simple moving average to the downside, then that's when I start to get concerned. If the stock market bounces off the 20-day simple moving average, then that is actually a good thing and a sign of a healthy stock market. In plain English, the stock market went on a crazy run that was too much too fast, and a pullback is expected. I've been sitting on this image and waiting to use it, and finally I've got the chance. The stock market is not dead yet, and the thing to do now is to see how the market reacts over the next few trading sessions. If the market consolidates or goes up, that's a good sign. If the market goes down and breaks through those 20 and 50-day simple moving average, then that's the time to get worried. The truth is, nobody has a crystal ball for the stock market, and the worst thing you can do is fall for the hype and the media sensationalism. Their job is to write crazy headlines and get your attention. Your job as an investor should be to separate yourself from the noise and study the data and charts so you can make the best investments possible. It's entirely possible that yesterday's drop is a real gift for investors that do not panic and understand how the stock markets really work. And if you would like to set up the same chart I showed for free, you can use Webull Desktop 4.0. You just have to set your simple moving averages to 20, 50, and 200, and you'll get a chart just like this, and it's really easy to set up and very useful. Just use the link in the description below, and if you have any questions, drop them in the comments below, and I'll do my best to give you the help you need. I know that a lot of people are panicking since yesterday was a bit of a bloodbath, and my goal with this video was to ignore the hype and look at the data. And even though yesterday was a big hit, I don't think there's any reason to panic yet because the stock market is just doing a healthy pullback at this point. My advice is to stay calm and see what happens over the next few trading sessions. I really hope that you guys enjoyed today's video, and always, if you don't mind smashing that thumbs up button, please do, because it helps the YouTube algorithm in a major way, which helps my video reach more people. Be sure to follow me on Instagram and check out my Patreon if you'd like to receive easy-to-understand fundamentals on stocks for just $20 per month. If you have any ideas for me, make sure you let me know in the comments down below, and if you haven't already received a free stock from Webull worth up to $1,600, use the link in the description. I really like their new Desktop 4.0 trading platform, and it's definitely worth checking out. Sending love your way, thanks so much for watching. Stay profitable, and I'll see you on the next video.